All right, let's talk about TD SYNNEX, ticker SNX. This one is a real head-scratcher. The company just put up some absolutely stellar numbers for their fourth quarter, a total blowout. But then the stock took a nosedive. So what's going on here? What did Wall Street see that sent everyone running for the exits? We're going to dig in and try to figure it out.
So yeah, this is the central mystery, right? Record earnings, but the stock gets hammered. It just doesn't add up on the surface. You've got TD SYNNEX absolutely crushing it. A record quarter by pretty much any measure. And for a minute there, in pre-market trading, it looked like the stock was going to fly. But then, bam, it completely reversed. The big question is, what spooked investors so badly? Let's get into it.
Okay, so Section 1, a record quarters paradox. Let's start with the headline numbers. And honestly, before we get to the drama, we've got to look at the good news. And there was a lot of good news. I mean, management themselves called it an outstanding year. And when you look at the numbers, you can see why. It's really hard to find any fault here.
First up, let's talk earnings, the bottom line. Their non-GAAP EPS, which is just a fancy way of saying profits without some of the one-off accounting stuff, came in at $3.83. Now, the street was looking for $3.73, so that's a solid 10-cent beat. More importantly, that's up a whopping 24% from last year. I mean, that is some serious profit growth.
And it wasn't just on the profit side. The top line, their revenue, was also on fire. They brought in over $17.3 billion. To put that in perspective, the consensus estimate was for $16.9 billion. So they beat that by almost $500 million. That's a huge beat, and it's up 10% year over year. So you've got strong profits, strong sales, it's the whole package.
Okay, now this next number is really important for a company like TD SYNNEX. We're talking about their non-GAAP gross billings. Think of this as the sticker price of everything they sold. All the servers, software, you name it. They hit a new record, $22.5 billion. That's billion with a B, and it's up 13.5% from last year. It just gives you a sense of the incredible scale we're talking about here.
So let's just recap, right? Look at this table. They beat on revenue, check. They beat on earnings per share, check. They hit a record for gross billings, double check. They even returned $108 million to shareholders through buybacks. I mean, on paper, this is an A-plus quarter. You couldn't ask for much more. Which brings us back to that nagging question. Why on earth did the stock fall off a cliff?
All right, Section 2, decoding the market stouts. This is where things get really interesting. The puzzling price action. Because like we said, after a report that strong, you'd expect a party. You'd expect the stock to go to the moon. But nope, not what happened. Let's break down that wild ride the stock took.
Man, this chart really tells the whole story, doesn't it? So look here, the stock closed the day before at about 151. Then the earnings came out, and in the pre-market, it pops, jumps up to almost 154. Everything's looking great. But then the market opens, and the floodgates just open. The sellers come in, and they hammer it all the way down to a low of 144. That's a $10 swing from the pre-market high. It's the classic definition of sell the news. But the question remains, why?
You know, what was happening that day was really a battle between two completely different narratives. On one side, you had the bulls. They're looking at the report, pointing to the record results, the double-digit growth, and they're screaming, "This is amazing." But on the other side, you had the bears, and they were whispering, asking some really uncomfortable questions. Things like, okay, great quarter, but is it sustainable? Are their margins going to hold up? And most importantly, what did they say about the next quarter?
Okay, Section 3, management's go-forward playbook, or the path ahead. See, to really get why the market got so spooked, we have to stop looking in the rearview mirror at the great quarter and start looking through the windshield at what's coming. And on the earnings call, management did just that. They laid out their game plan to convince Wall Street that this isn't just a one-hit wonder.
So what's the plan? Well, they broke it down into 4 main pillars. First, omni-channel engagement. Think frictionless digital portals, AI assistants, just making it super easy to do business with them. Second, they're doubling down on specialized growth, getting really deep into the technical weeds. Third, best-in-class enablement. This is cool. They're running advanced workshops like their AI game plan to train up their partners. And finally, expanding brand visibility. They don't just want to be a distributor. They want to be an absolutely essential partner.
And the CEO, Patrick Zammit, he put it pretty bluntly. He said, and I'm quoting here, "Our performance is a direct outcome of executing on the strategy we outlined." Basically, he's saying, hey, this incredible quarter, it wasn't an accident. This is our plan working exactly as it should. That's a confident statement for sure. But, talk is cheap. The market wanted to see the numbers, the forward-looking numbers.
And here we go. This is very likely the smoking gun, the guidance for the next quarter.
So, on the one hand, they're guiding for gross billings to keep growing at a solid clip, around 12%. That's pretty good. But then, you'll look at the non-GAAP EPS. They're guiding for a range that puts the midpoint right at $2.95. Wait a minute. They just posted $3.83. That is a massive sequential drop. For a business that runs on thin margins, that set off all the alarm bells. And that's the fear that took over. Was that amazing fourth quarter the peak?
All right, last section, the next call. This is where we put it all together and give our rating and thesis. So we've seen the incredible results, the totally bizarre stock reaction, and the guidance that kind of poured cold water on the whole party. So where do we go from here? It's time to make a call.
But first, real quick, I want to define a term we're about to use, market perform. All it means is that we expect the stock to pretty much move in line with the broader market, say the S&P 500, over the next 12 months. It's not a buy, it's not a sell, it's a neutral rating. It's our way of saying we think the stock is probably priced about right, for now.
So with that in mind, our official rating for SYNNEX is market perform. Now look, let's be clear. This is a well-run company that is executing at a very high level. But you have to remember, the stock had a monster run leading into this report. Expectations were through the roof. So when they put out that guidance that hinted at a slowdown in profitability, well, we think the market's cautious reaction was probably justified. The stock looks pretty fairly valued right where it is.
So if you're looking to make a trade around this, what could you do? Well, one plausible idea, if you believe this post-earnings dip was an overreaction, is to bet that the stock has found a floor. A way to do that is by selling out of the money puts. Now, this is getting a little technical, but essentially you're getting paid a premium to agree to buy the stock at a lower price. It's a bet that the stock won't fall much further. Of course, there are risks. A big one would be a major economic slowdown. Or what if those margins compress even more than the guidance suggests? Those are things you'd have to watch out for.
And of course, we have to say it, this is not financial advice. We're just breaking down the numbers for informational purposes. Always do your own research.